So there is a current policy debate about whether or not banks are safer now than before the crisis. For example, Janet Yellen last year at the Jackson Hole conference said yes, because regulation has imposed banks to progressively decrease their book leverage, banks should be better able to absorb a negative shock, and so they should be safer now than before the crisis. At the same time, Natasha Sarin and Larry Summers have suggested that if you look at market signals of credit risk, such as market leverage, it has gone up since the financial crisis, so banks are not safer than before the crisis. So we will see during this talk that market and book measure give opposite signals because they are addressing different concepts of bank safety. But the tension between book and market measurement of bank safety can be crystallized in the market to book ratio of equity. The reason why market and book measure of safety have gone in opposite direction is because this ratio has changed over time. So as it should be clear on this picture, the market to book ratio of equity was around 1 from 1970 to 1984, then rose to 2 from 1996 to 2007, and fell back to 1 after the financial crisis. So what does the market to book ratio of equity signals about bank safety? What is driving the market to book ratio of equity? Well, the literature has pushed to interpret a high market to book ratio of equity as reflecting a high franchise value of the bank. The bank could have economic capital that is not directly reflected on the balance sheet. They could have a source of monopolistic power or some intangible capital that gives them this franchise value. Now, Natasha Sarin and Larry Summers have pushed for the argument that regulation has damaged this franchise value and is responsible for the drop in the market to book ratio of equity. Now, we would like to argue in this paper that the market to book ratio of equity could be high because the liabilities of the bank are backed by government guarantees. Equity holder and the bank do not have to compensate debt holder for the risk they are taking. They're reaping off the benefits of taking risks during normal times, and it is the government that intervenes and pay back depositors during a financial crisis. Now, if the drop in the market to book ratio of equity from 2 to 1 that we observed during the financial crisis is reflecting a decline in the franchise value of equity, then the continuation value of the bank declined. Banks are closer to bankruptcy now, and they are less safe now than before the crisis in the sense that market equity and debt holder are still at risk. Now, if the decline in the market to book ratio of equity is reflecting a decline in the value of government guarantees, if by imposing regulation on banks, by imposing to reduce their book leverage, we reduce the taxpayers' liability to bail out banks during a financial crisis, then in that sense, banks are safer now than before the crisis. So in this paper, we're going to provide a theoretical and empirical model to try to decompose the changes in this market to book ratio of equity, MEBE, whether it can be accounted by changes in the franchise value of equity, FE, or the value of government guarantee, GOV. So how do we proceed? Well, first, we're going to use bankers' estimates of fair value of loans and deposits that they compute and report themselves to construct the franchise value of equity. Then we're going to use a Gordon growth dividend model and use accounting data on profitability and leverage of bank to try to see how much of the market to book ratio of equity can be accounted either by changes in the franchise value or changes in the value of government guarantees. Let me turn now to our model. So we consider a model set in discrete time, where at every period a random state is drawn according to a risk-neutral probability. We assume a constant risk-free rate, so we abstract for interest rate risk. On the balance sheet of the bank is going to have loans on its asset and government guarantee deposit D and book equity BE on its liabilities. Now, all the components of the balance sheet of the bank are going to grow at the same rate G of S. Now, what is the franchise value of equity then? Well, we can attach a fair value to the loan operation of the bank. Bankers receive interest rate on these loans, net of servicing cost. Some loans are going to mature and some loans are going to default. So the fair value of equity is then the expected present value of all of this cash flow. We can do a parallel calculation for the deposit arm of the bank. Bankers pay interest rate to depositors, servicing cost, and some customers are going to withdraw money. So again, the fair value of a $1 deposit is then simply the expected present value of all this cash flow. Now, to estimate both of this fair value of loans and deposits, we're going to use directly bankers' estimate of these numbers. Now, the franchise value of equity is then simply the difference between the fair value of loans and deposits and the book value of loans and deposits. So intuitively, you could have a high franchise value because you are able to lend at higher interest rates than market rates, and you're able to borrow funds at market rates, at rates lower than market rates. So what is the market value of equity? Well, we show in the paper that we can write the dividends that we're going to use in our Gordon growth dividend model as the excess return that you receive on your risky loan that you purchase at price VL plus interest that you would receive on loan and deposit if you were taking no risk. So intuitively, by increasing the quantity of risk that the bank is taking, you can increase the excess return that you receive on your loans. Now, the market value of equity is then the expected present value of all of this cash flow, taking into account the option to default. Now, if at any state the cash flows of the bank plus the continuation value of the bank is negative, equity holders are going to decide to default. And during a bankruptcy, equity holders are not going to pay back depositors because of limited liabilities. So the government is going to seize the bank, and as we have seen in the case of Bear Stearns and JP Morgan, is going to inject cash in the bank to assist the sale of the bank. So the value of these government guarantees, of this cash injection, is then simply the expected present value of all this future cash injection. Importantly, in our framework, Monig-Leoni-Miller holds if you recognize that the government has a negative stake in the bank. So equity holders benefit from these government guarantees because they're reaping off profit during normal times, and it is the government that comes to pay back depositors during a financial crisis. Without government guarantees, the market value of equity will simply be equal to the sum of the book value of equity and the franchise value of equity. So how do we price? So then our framework is providing the decomposition of changes in the market-to-book ratio of equity into changes in the fair value of equity and government guarantees. So to price the value, this option value to default, and the corresponding side, or the side of this option, which are these government guarantees, we need to calibrate the risk that banks are taking on their asset portfolios. To do so, we're going to look at excess return on portfolio of diversified corporate bonds. Let's not forget that portfolio of government bonds not only contains loan to firm, but also all the asset-backed securities. Now, on this table, you can see the realized annualized excess return that you would receive on this different portfolio of different rating classes during the financial crisis and the normal times. As you can see, most of the time you earn this small premium, and then every now and then you got hammered by a crisis, which turns out to be optimal for equity holder to benefit from these government guarantees. Now, using this number provides a very useful benchmark for imputing the total losses of this portfolio during the financial crisis. Now, as you can see, the more risk you're taking, the more you're going to lose during the financial crisis, and the more is your excess premium during normal times. So, a bank that would have assets that have risk equivalent to BBB corporate bonds with 10% of equity would become insolvent during the crisis. Now we assume two states, normal times and crisis, and to calibrate the risk-neutral probability of a crisis, we use the fact that by arbitrage, under the risk-neutral probability, the expected excess return have to be equal to 0. So we have one formula, 3 variable. We use the losses during the financial crisis to set the excess return during crisis times. Then if we set the risk-neutral probability of normal times to 0.95, then we have that the formula is giving us the implied excess return during normal times. And as we can see, by choosing a risk-neutral probability of a crisis of 5%, we get implied excess return during normal times that is sufficiently close to what we observed in the data. So before going to the full accounting exercise, I want to demonstrate that the value of government guarantees not only can account for the high level of market-to-book ratio of equity before the financial crisis, but can also account for the change from 2 to 1 that we observed after the financial crisis. For this exercise, I will use a stylized bank that issue liabilities backed by the government and that has assets with credit risk similar to portfolio of corporate bonds. We assume a reasonable risk-free interest rate and a growth rate that we observed on the balance sheet of the banks before the financial crisis. So here is the formula for the market-to-book ratio of equity of such a bank. If this ratio is lower than 1, it means that the bank is not taking enough risk to benefit from government guarantees, and then is not going to decide to default during a financial crisis. Now, if you use the losses on this different portfolio to calibrate the loss during the financial crisis, you use the calibration of the risk-neutral probability of a crisis of 5%, then you can compute the implied market-to-book ratio of equity here, and you're going to have a certain implied return on equity given a certain level of book leverage. Now, what we find remarkable, what we find surprising, is that a bank that would have assets that have credit risk similar to BBB corporate bond already generates a market-to-book ratio of equity of 2. Then if you are Janet Yellen and you pass regulation to decrease the book leverage of the bank, you completely wiped out the value of these government guarantees. So all you have to believe here to be able to account for the high market-to-book ratio of equity before the financial crisis and the subsequent jump from 2 to 1 that we observed is that the assets of the bank have credit risk similar to portfolio of corporate bonds BBB. So this result actually reconciled the view of Yellen with the view of Sarin and Summers. If your concept of safety is the protection of the taxpayer, because by reducing the book leverage from 90% to 85%, we wiped out this value of these contingent liabilities, then banks are safer now because the taxpayer liabilities is smaller now than before the crisis. Now, if your concept of safety is the protection of debt and equity holders of the bank, then banks are not safer because they are still enjoying a small value of these government guarantees. They would still go bankrupt during a financial crisis, and in that sense, the bank is not safer as they are still at risk. So let's move now to the full accounting procedure. In the first step, we're going to measure the fair value to construct the franchise value of the bank, and to do so, we're going to use bankers' estimate of the fair value of loans and deposits. Then we're going to use our Gordon growth dividend model, use all the accounting data that we have on accounting profitability and leverage, and use our formula to see how much of the market-to-book ratio of equity can be accounted for franchise value or government guarantees. So bankers have to report in the footnotes of the annual report the fair value of the loans. We collect these numbers for 19 large banks on their annual reports. We aggregate the numbers. What we find is that before the crisis, the fair value of loans is about 2.5% of the book value of loans before the crisis, and almost disappeared after the financial crisis. Similarly, for deposits, we have two sources. One is the portfolio model developed by the Office of Thrift Supervision, and the second one is coming from whole bank transactions. So basically, when one bank acquires another, bank accountants have to justify why they overpaid for this deposit. So this reported number that they called core deposit intangible showed that the fair value of deposit before the financial crisis was about 2.5% and also substantially declined after the financial crisis. So there is evidence that indeed the franchise value of the bank significantly dropped after the financial crisis. Now, when we do our full accounting exercise, we find that the fair value of equity can account for 48% of the book value of equity. Similarly, when we use all the accounting data on bank profitability and leverage and interest rate that we observed during our period, we find that more than half of the market-to-book ratio of equity is accounted for the value of government guarantees. Both of these components significantly dropped after the financial crisis. So again, we reconcile the view of Yellen with Sarin and Summers. If your concept of safety is the protection of taxpayer, then banks are safer now because we significantly reduce the contingent liability of bailing out banks during the financial crisis. If your concept of bank safety is the protection of equity and debt holders, then the banks are still as risky as before because they still enjoy some value from government guarantees and would still go bankrupt in a financial crisis. Now let's go back to our original picture. If you look at the market-to-book ratio of equity, we successfully explained the high level before the financial crisis and the subsequent drop after the financial crisis. But what happened in the mid-80s that we observed the rise from 1 to 2? Well, what is remarkable about banks is how much profitable they became in the mid-80s. To make that concrete, we can develop a benchmark return on equity, which would be the return that you would receive if you were taking no risk. So intuitively, if you have no franchise value, this return should just be equal to the risk-free interest rate. Now, if you have franchise value, here is simply the modified formula for the risk-free return on equity. So we use this formula to decompose the observed accounting profit during our period, to decompose the accounting return on equity into one fraction that can be high because there is high interest rate or you have some franchise value, and one portion that comes from the fact that you're loading on aggregate credit risk. And what we find is that in the mid-80s, banks significantly increased the fraction of the accounting returns that comes from taking risk. Now, to conclude, our work is suggesting that moves to lighten the regulatory burden on banks should be met with caution. We have seen that the valuation of government guarantees is highly sensitive to the quantity of risk that the banks are taking. So if regulators allow even a moderate increase in risk-taking by banks, we should observe a significant jump both in the market valuation of banks and in their accounting profitability. The temptation will then be to interpret this increase in market valuation and accounting profit as a restoration of the franchise value that was damaged by regulation. Instead, we would like to argue that it would be better interpreted as a restoration to the times where the taxpayers had a large contingent liability to bail out banks during the financial crisis. Thank you.